This is High Level Investing for Dummies, not Normal Level Investing for Dummies, no, High Level Investing for Dummies, by the publisher A. Wiley Brand and the authors Paul Mladenovic, CFP, Certified Financial Planner, author of Stock Investing for Dummies. Of course, I know that you're interested about the previous chapters, chapter 2 and 1, but sadly I haven't read them. If you'd like me to read them, then comment down below and I'll think about reading them. Chapter 3, Surveying Diversification and Allocation Strategies. In this chapter, telling the difference between diversification and allocation, checking out stock sectors, thinking about personal factors. You just saw one of your stocks jump 200%. You're thrilled, but you had only a piddly 50 shares. Man oh man, if only you had allocated more to that stock. A great stock in your portfolio may mean little if the allocation and diversification are off. Obviously, you want a higher portion of your money in the super successful category, but the precise amount depends on several factors, some of which may not be directly tied to stock investing. How much of your money should you have in a particular stock or sector? How much should you allocate to aggressive versus conservative stocks or exchange-traded funds, ETFs? There's no hard and fast rule here. This chapter is about guidelines because diversification and allocation have many factors tied to them, and investors are a varied bunch. Note, every investor is unique and there isn't a one-size-fits-all model for diversification and allocation. If you have difficulty with this task, seek a financial advisor who specializes in investing and portfolio management, understanding diversification and allocation. The difference between diversification and allocation tends to blur, so let's square this away immediately. Diversification is having different investments, A, B, C, and D. Allocation, also called asset allocation, is how much of each asset or set of assets you should have. For example, if diversification is having stocks, bonds, cash, real estate, precious metals, and collectibles, then allocation is making the call to put 30% in stocks, 20% in bonds, and so forth. Proper diversification takes into account a proper proportion. If your holdings are A, B, C, D, and E, then all things being equal, each should be allocated 20%. Diversification is important because having a different mix of assets reduces too much exposure and therefore risk to any particular asset, because different assets have different risk profiles. The strengths and weaknesses of each asset are offset by another asset's different strengths and weaknesses. For example, stocks may have the strength of being able to grow, but they also have the weakness of going down. Cash, such as in savings accounts, also have the weakness of going down. Cash, such as in savings account, may not have the risk of falling in value due to market moves, but it doesn't have the strength of growing as stocks do. Given this, a prudent investor will have a mix of both. Diversification is meant for safety just as much as it is for growth, maybe more so. You can't see the future, and even if you choose the investment of the century, that investment can and will behave in unpredictable ways, and the time frame of success will differ from your expectations. Diversification gives you areas of your portfolio that will do well when your expectations and aspirations are not met. Keep in mind that the market's time frame is out of your control. It ebbs and flows with the cumulative buy and sell orders that come from a large group of investors, all of whom have different expectations and needs. In other words, you may think that your chosen stock or ETF is ready on the launchpad for soaring success, but the market may ignite and launch another stock industry or sector, or a different type of investment altogether. The following sections give you some points to consider as you choose how to diversify and allocate your investments. Cyclical or defensive, preparing for different economies, stock sectors, and frequently different subsectors in the same sector. Behave differently in different economies. A properly diversified portfolio includes investments that perform well in a strong economy and others that hold up when the economy is weak. These sectors can be categorized as cyclical or defensive. Cyclical means that the company in question has its fortunes rise and fall in tandem with the economic cycle. In other words, if the economy is doing well, this type of stock or industry is doing well. Examples of cyclical stocks are auto, home improvement, and technology stocks. Defensive sectors or industries hold up well in tough economic times, but don't tend to perform as well as cyclical stocks in good times. Examples of defensive stocks are food and beverage companies and utilities. I identify some cyclical and defensive sectors later in digging into stock sectors. A mix-up, avoiding perfect correlation. In the financial markets, correlation is a statistical measure of how two or more stocks or other securities move in relation to each other in the same market conditions. As a particular matter, the investor or speculator uses correlation to help construct a portfolio to maximize gains or minimize losses in the portfolio. You look at security A and ask yourself, is it negatively or positively correlated to security B? In other words, will security A move in tandem with security B, or will it go the opposite way? Preparing for different outcomes. In proper diversification, you make sure that you don't have 100% of your securities perfectly correlated. For example, suppose you have securities all connected to a bullish scenario for energy. Your portfolio seems to be diversified because besides oil stocks, you also have fracking stocks, solar stocks, uranium stocks, and so on. But these groups of stocks tend to be correlated. In other words, if one is down, the rest tend to be down too. You do extremely well when a bullish scenario indeed unfolds, but when the market moves against you, the entire portfolio gets hammered. Sometimes correlation equals devastation. When you have the bulk, all of your portfolio, correlated for one outcome, you're too weighted for a particular scenario. If the scenario doesn't occur, that will mean either stagnation or decimation of your portfolio. Diversification without considering correlation can do harm, so take correlation seriously. Have proper diversification through the bulk of your portfolio, or if you're willing to go all in for a particular scenario, have a hedging strategy in case you're wrong or the market gives you a temporary setback. Also, keep in mind that correlation isn't just an issue that individual stocks have with other stocks, or that one stock sector or industry has with another. It's also an issue with different classes of investments. If you check your favorite site and see that corn and soybean prices are sharply down, you may not want to look at your agricultural stocks without taking an anti-asset. Personally, I don't take any anti-acid. I don't know if you take any anti-acid, but I don't think that people between the ages of 18 to 25 would usually take anti-acid under normal circumstances. I don't know. Maybe you're above that age limit. Maybe you're below it. Maybe you have a specific circumstance that makes you take anti-acid. Anyways, quantifying and charting correlation. Correlation is a computed value. In technical lingo, that value is referred to as the correlation coefficient, and it moves in a range between -1 and +1. Positive correlation. A perfect positive correlation, a correlation coefficient of +1, implies that as stock A moves up, down, or sideways, then security B will move exactly 0.9, pretty darn close, or 90%. Two large cap oil stocks, for example, tend to have a very positive correlation, so their correlation coefficient will be at or about +1. Negative correlation. A perfect negative correlation, -1, means that if security A is moving in one direction, security B will move in the opposite direction. A good example of negative correlation is gold and currencies such as the US dollar. Usually, when you see a strong up move in one security, you tend to see a down move in the other. Are there days when both will be up or down simultaneously? Yes, but those moments are few and far between. Correlation will never be truly perfect, but 9 times out of 10, it will be a reliable indicator. No correlation. If the correlation for securities A and B is 0, then the movements of the securities are said not to be correlated. The movement is random. Correlation tracks movement, so you can use a chart to see the movements of both securities over an extended period of time and have a reliable gauge of correlation. Most financial sites let you create a chart for a particular stock or ETF and then place a second security on the same chart, so you can see how similarly or dissimilarly they move. Try sites such as MarketWatch, Bloomberg, and Yahoo Finance. Just enter the stock symbol and decide which chart to view. Choose 5 years or longer so you have a clear long-term pattern of the movement of both securities given the same market conditions and time frame. Allocating according to your personal situation and goals. Stocks are meant to be a great performer in your total portfolio, but you should review other factors that could radically change your goals. Regularly review your total financial situation as it relates to your personal job and business concerns. In other words, consider reviewing your personal, this is of course a reminder, your personal situation and your future goals with a financial planner to make sure that stocks are playing an appropriate role in your overall financial plan. Your personal situation and goals have the lion's share of consideration for which securities you should have and how much to allocate to each category of securities. For example, allocation strategies for Bob, a 30-year-old heading into his peak earning years, are quite different from allocation strategies for Jane, a 65-year-old on the cusp of retirement. Bob would allocate more money to growth-oriented stocks, ETFs, and other assets, and Jane would most likely allocate more money to income-oriented securities such as high-dividend stocks and investment-grade bonds rated AAA. Therefore, knowing yourself is more important than understanding securities. After all, you can always get a financial professional to help you with securities selection if needed. I discuss personal factors later in the section, fitting in your personal factors. When gauging your risk tolerance and the timeline for your goals, pay attention to market conditions as dictated by the general economic and geopolitical situation, also known as the big picture. Find out more in Chapter 19. Typically, both bull and bear stock markets tend to last for years, so it pays to understand and respond to the major factors that affect them. If the economy is in a generally good shape, and you feel that your personal situation is favorable, you have a good secure job and such, you can be more aggressive if you so choose. If the economy is experiencing a recession, the times seem uncertain and your personal situation seems tentative, my company will be cutting back, make more conservative allocation choices, digging into stock sectors. Where will your money go? There are 9 stock sectors composed of 32 subsectors, give or take. And within those subsectors are numerous industries. When you're ready to diversify your stock investments, here are your choices in terms of sectors. Note that stocks, whether they're the stars of your total portfolio or not, shouldn't be the be-all and end-all of your total wealth building program. Different types of investments bring different strengths that augment and complement your stocks. Speak to your financial advisor about diversifying with bonds, real estate, bank investments, and other alternatives to stocks. Basic materials. The basic materials sector includes base metals such as copper, zinc, iron, and nickel, precious metals such as gold and silver, and chemicals and synthetic materials. Some of these subsectors perform differently in the same economic conditions. When the economy is doing well, base metals and related stocks do well, while precious metals and related stocks tend to do poorly. In other words, base metals and related stocks generally have a negative correlation to precious metals and related stocks. That's a lot of related stocks. How many times did I say related stocks? Twice. No, 3 times. It's in a line. Related stocks, related stocks, related stocks. I covered correlation, negative and positive, in the earlier section. The mix-up, avoiding perfect correlation. Basic materials include the general world of commodities and hard assets, which means opportunities for stock investors to diversify away from the general stock market. There are even ETFs that allow investors to invest in the actual materials, such as gold, silver, oil, and grains. Find out more about ETFs that can be bullish or bearish in these specific commodities in Chapter 9 and 10, Communications. The communications sector encompasses the world of television and radio broadcasting, movies, and related industries. Consumers need their news and entertainment, which fill up their flat screens. The communications sector encompasses the world of television and radio broadcasting, movies, and related industries. Consumers need their news and entertainment, which fill up their flat screens, tablets, and smartphones. This industry tends to be steady and is more likely to be considered defensive rather than cyclical, even though some subsectors, such as movies and plays, can be considered wants, not needs. They hold up well even during bad or recessionary times because consumers need diversions, perhaps especially during bad times. Conglomerates. Far from the Hollywood movie that depicts a conglomerate as an evil enterprise where the CEO is having his mwahaha moment. What moment? A mwahaha moment. Conglomerates are just large, diversified, a mwahaha moment. Not to be mistaken for any other moment, it's a mwahaha, evil moment. Conglomerates are just large, diversified companies involved in a variety of unrelated products and services. General Electric, Sybil GE, Honeywell, HON, and Berkshire Hathaway, BRKA, and BRKB are good examples of conglomerates. Divisions of these companies may operate in different industries. Conglomerates also tend to have operations in different countries or regions of the world. Because conglomerates are diversified within their operations, they aren't as susceptible to slowdowns or other negative conditions in the domestic or world economy, giving conglomerates some safety. I repeated conglomerates maybe 30 times. Consumer goods, discretionary and staples. Consumer goods encompasses a wide variety of products and services, usually associated with consumer wants and needs, such as food, beverages, auto parts, electronics, furniture, and kitchen appliances. This sector is large, so it's useful to drill this one down to two large subsectors, consumer discretionary and consumer staples. For the sake of brevity, for the sake of being clear, consider consumer discretionary as wants and consider consumer staples as needs. Here's how the subsectors can help you diversify. When the economy is doing well, consumer discretionary tends to do well, while consumer staples lag. When the economy is struggling, consumer staples tend to do well, while consumer discretionary tends to lag. This stock market category is so broad that it's impossible to say whether it's safer or riskier for investors than other sectors. Ultimately, the decision comes down to an investor's individual choices regarding certain types of products or particular companies within the sector. Of course, conglomerates, the CEO isn't having a mohaha moment, okay? That's very important to remember. For example, whereas food and dairy products, as well as their manufacturers, may thrive even during a recession, vehicles and electronics. Did I read this? This stock market category is so... Yes, I read this. For example, whereas food and dairy products, as well as their manufacturers, may thrive even during a recession, vehicles and electronics may bring losses to investors. Investors who consider operating within the consumer goods sector should be aware that companies that sell consumer goods generally trade in the services sector, which I describe later in this chapter. Okay. Consumer goods generally sell in services sector. Trades in services sector. So most consumer goods are services. That is what I understand from this paragraph. For example, whereas food and dairy products, as well as their manufacturers, may thrive even during a recession, because it's a staple. Vehicles and electronics, it's a discretionary good. It's a discretionary consumer good. May bring losses to investors. Investors who consider operating within the consumer goods sector should be aware that companies that sell consumer goods generally trade in the services sector, which I describe later in the chapter. So most consumer goods are services. Energy. Energy is frequently referred to as the operational lifeblood of the economy because it's necessary for many of the physical functions of a modern economy: driving a car, turning on the lights, operating technology, and so on. So this sector doesn't neatly fall into either cyclical or defensive. It's similar to healthcare in that some energy industries are cyclical and some are not. Some are cyclical, some are not. Financial. The financial sector is a large sector that includes banks, both money center and regional, stock and future brokerage firms, insurance companies, mortgage companies, and other financial institutions. That is a lot of lingo I have to understand. This sector can be vulnerable to debt-related turmoil during times of economic uncertainty. The financial sector is fine when the economy is growing and stable, but it can be dangerous when borrowers are having difficulty maintaining their debt obligations. As I write this, in 2015, massive debt is being serviced in this sector and interest rates are at historically low levels. To service debt means to meet the terms of carrying it, paying monthly payments, for example. What happens if and when interest rates start to rise and borrowers have difficulty paying back what they owe? In times of economic weakness, the financial industry is vulnerable, so consider the sector to be negatively correlated with economic strength. The financial sector is vulnerable during regular economic weaknesses, and it may become even more vulnerable during 2015 through 2017. I think that's true. I think that's what happened. As trillions of dollars of debt are subjected to rising interest rates or falling creditworthiness among the borrowers. This is an important warning to pay attention to through 2015 to 2017. It's already happened, and I think it's true that there was some struggle in the financial sector during 2015 to 2017. Thank you very much for your time, and I'm going to be getting back to healthcare, industrial goods, services, technology, transportation, and utilities in 1 second. Healthcare. The healthcare sector is a large sector that has a mix of subsectors and industries including hospitals, pharmaceuticals, medical technology, and equipment, drug retail stores, health insurers, and laboratories. These subsectors behave differently in the same economic conditions. So the healthcare sector has a lot of subsectors and industries, including hospitals, pharmaceuticals, medical technology, and equipment, drug retail stores, health insurers, and laboratories. These subsectors behave differently in the same economic conditions. Some subsectors, such as medical technology and equipment, are cyclical. Others, such as drug retail stores and hospitals, are defensive. Because of the aging of the US population, with 78 million baby boomers born between 1946 and 1964, then he put a apostrophe. Is that an apostrophe? Yeah, I think that's an apostrophe. Exclamation mark. He put an exclamation mark. So, with 78 million baby boomers born between 1946 and 1964, oh my god, investors can expect a megatrend in this sector. Industrial goods. The industrial goods sector includes heavy manufactured goods, defense and aerospace companies, construction, textile and industrial management, and waste management. This sector is cyclical and its fortunes are tied to two basic factors: the business economic cycle and government spending. Government spending plays a role here mainly because of spending on defense and infrastructure such as roads and bridges. Services. The services sector is diverse and it includes many industries such as accounting, advertising, web design, hairdressing, employment services, plumbing, and carpentry. However, the sector isn't very large in terms of stock investing. There are a few major services subsectors, so scrutinize any firm that you choose to invest in regarding how well it may perform in good and bad times. This sector contains a mix of both cyclical and defensive offerings. A good example of a defensive service is tax planning and preparation. I think Equifax, the stock Equifax, has something to do with that. Because people have tax services needs regardless of economic conditions. A good example of a cyclical service is home improvement because it's typically expensive and tends to be done during good times. Technology. The technology sector is popular among growth investors and it includes companies that manufacture, market, and/or service technology. This sector also includes software and all things tied to the internet. Examples of successful tech companies include old technology firms such as IBM, symbol IBM, and Hewlett Packard HP, and new technology firms such as Google and Apple. In recent years, this sector has been a strong performer, and it will continue to be so. As of the publication of this book, 2015, up to date, 2025, 10 years later, this has held out to be true. Transportation. Transportation takes into account various industries such as trucking, railroad, and other delivery services, for example, Uber. It's actually a key industry to watch because many analysts see it as a harbinger for the rest of the economy. Transports doing well indicates increased economic activity, such as more goods being shipped. If transportation doesn't do well, then that doesn't bode well for the economy at large, given that the transportation sector is essentially cyclical. Utilities. The utilities sector has 4 domestic subsectors: electric, gas, water, and diversified. It also includes foreign utilities. A relatively new entrant in this sector is alternative energy, such as solar and wind energy technology. Utilities aren't easy investments, so they require thorough research. The utilities sector heavily relies on the government because energy prices are often government regulated and renewable energy producers use government grants. To do research on utilities and other sectors, here are some great resources: Morningstar, Value Line, Zacks Investment Research. Fitting in your personal factors, it's time for your personalization. In other words, how about you? What personal factors will affect how you construct your portfolio? Don't fret over perfection. The pros certainly don't. Some of your diversification and allocation choices are based on personal factors that aren't easily quantifiable, such as your risk tolerance and comfort level. No matter how aggressive you are or how well you think a particular stock or ETF is going to perform, keep in mind that at least 80% of your portfolio should take into account your optimal profile as an investor. I think that means 80% of your portfolio should be like something you trust. Time frame issues. Investing is a long-term activity. This means that wealth building with this type of investment is best done over years, preferably 5 years or longer. Anything shorter than, say, a few years, and you no longer call it investing. Call it trading or speculating. In the following sections, you see what's appropriate for diversification and allocation given your time horizons. Because you may have different or multiple goals, consider allocating money for each goal. In other words, dividing money into separate buckets so that each bucket is devoted to a specific goal. Short-term considerations. If you're accumulating assets or money for a short-term goal, such as financing your kid's college education next year, I still don't have kids, or a down payment on a new home, I'm not going to get a down payment on a new home anytime soon, or investment property, then you should have little or no money in stocks or stock-related ETFs. They aren't appropriate for short-term considerations. For short-time frames allocate your money in savings accounts, bank investments such as certificates or deposits, with a maturity commensurate with your chosen deadline, or short-term venues such as money market funds, There have been times that the stock market did very well in a relatively short time frame, such as a year or 18 months. However, too many people have been hammered mercilessly when the market reversed in a similar time frame. You can't bank on a short-term rally because that's out of your control. That's a warning. Intermediate term considerations. The intermediate term is 2 to 5 years, although some consider the intermediate term to be 1 to 4 or 5 years. Here you can start to allocate some funds to stock investing. All things being equal, the stocks or ETFs should be in sectors considered to be conservative, such as consumer staples or utilities, if you're seeking some wealth preservation aspects in your portfolio. Too often, investors think of the intermediate time frame as the chance or the necessity to be aggressive because they want their money to grow quickly. However, fast growth potential also means volatility and risk potential. There's nothing wrong with trying to make fast money with some aggressive go-go stocks. However, in that case, you aren't investing, you're speculating. Warning. That's a warning. And now this is a reminder. Long-term considerations. Long-term considerations. Stocks are best suited for 5 years and longer. The long term, such as for retirement, any portfolio seeking gains and growth for this time frame should have a large percentage in stocks. If you're conservative in your approach, then stocks with an established growth record, see Chapter 4, and a long-term record of regularly raising dividends should be a big part of the strategy. Personal goals. What are your goals? What are you trying to do? Sometimes it pays to figure out your goals, how much you need and when you'll need it, and back up from there. Say you need an additional 1 million in 15 years. Personal goals. What are your goals? What are you trying to do? Sometimes it pays to figure out your goals, how much you need and when you'll need it, and back up from there. Say you need an additional 1 million in 15 years so that you have a comfortable retirement. Given your current assets, you need to grow your assets by only 5% per year to hit that level. Growing assets by 5% or even 10% in that time frame means that you don't have to be aggressive or take inordinate risks. A basket of quality, consistent dividend-paying stocks would get you there without undue risk or using fancy, complicated strategies. When you get a chance, head over to Bankrate. The site has some excellent, this is the website. If you don't know, www stands for World Wide Web .bankrate.com. I don't know what this com stands for. The site has some excellent investment projection calculators that can help you figure out how much capital you'll need to grow at a chosen rate so that you can achieve a certain value. Part of your success with stock investing and how aggressive or conservative your mix of investment should be depends on your measurable target. Your goals have a definite connection to your diversification and allocation. If you're an income investor, either for retirement or another income purpose, then it makes sense to largely fill your portfolio with stocks and bonds that generate income. Someone who's currently retired, for example, would have 80% or more of her portfolio allocated toward AAA quality bonds and stocks that have a high current income, such as utilities. If you're a few years away from retirement, then you would allocate little to bonds and instead have a high percentage, 50% or more, in stocks that are called dividend growers. Stocks that have a track record of raising their dividends year in and year out so that you get high and growing income later on when you're ready to start receiving the income. See Chapter 4 for more information. If your goal is to build wealth and you have a long-term outlook, say 10 years or longer until you need the money, then it makes sense to have a greater percentage of your assets in growth investing strategies such as individual stocks in growing sectors and some ETFs or mutual funds with the same objective. Your risk tolerance. Even if you have the right profile for your stock investing, you may not have the tolerance to do so. If you lose money or see your positions down temporarily, do you sleep easy? Does volatility give you nausea? When you lose $40 at the casino during your vacation, does it ruin your week? Yes, it ruins my week when I lose $40 at the casino. I'm not saying that stock investing is like gambling, but it isn't like your certificate of deposit. Either stocks go up and down constantly, I read that incorrectly. I'm not saying that stock investing is like gambling, but it isn't like your certificate of deposit. Either stocks go up and down constantly. The stock market is a marketplace. Okay, either. Stocks go up and down constantly. The stock market is a marketplace of stock buyers and sellers, which means that stocks will fluctuate. So if stocks are in your financial picture, get used to those changes. That makes sense. The conservative investor, the aggressive investor, and the speculator accept different degrees of risk. The conservative investor, you're investing in quality and your stock portfolio will likely have stocks that have or should have relatively low volatility. The conservative investor often has a high percentage of his or her portfolio in diversified utilities, food and beverage companies, drug retailers, and other defensive healthcare stocks. Overall, the stocks are generally dividend payers, adding stability to the portfolio. امسح الجزئية هذه امسحها. خليني دقيقة بس اشيك كاميرا ثانية. اوكي مزبوط. لا ابدا مننا مزبوطين يا حمار. كذا. اوكي. نحن تقرأ. Investing is like gambling, but it isn't like your certificate. هذه الجزئية خليها والجزئية اللي قبلها امسحها. أنا كررتها هذه المرة الثانية. Investing is like gambling, but it isn't like your certificate of deposit either. Stocks go up and down constantly. The stock market is a marketplace of stock buyers and sellers, which means that stocks will fluctuate. So if stocks are in your financial picture, get used to those changes. The conservative investor, the aggressive investor, and the speculator accept different degrees of risk. The conservative investor, you're investing in quality and your stock portfolio will likely have stocks that have or should have relatively low volatility. The conservative investors often had a high percentage of his or her portfolio in diversified utilities, food and beverage companies, drug retailers, and other defensive healthcare stocks. Overall, the stocks are generally dividend payers, adding stability to the portfolio. Technology investments may be a firmly established dividend-paying company, such as Intel and Microsoft. In addition, the conservative investor would have ETFs or mutual funds that are in consumer staples and other necessities. The aggressive investor. Nothing wrong with being aggressive. Just make sure you're aggressive with only a portion of your portfolio, and that you're not affected in a financially adverse way. In other words, if you lose money, you need to drastically alter your lifestyle or break into your kid's piggy bank to buy food or to pay for a margin call. Keep the distinction between investment capital and risk capital, and you should be okay. Investment capital is for investing, while risk capital is a smaller sum set aside and allocated for speculative trades. The aggressive investor still seeks companies that have some value, even if the underlying companies are losing money. An aggressive investment may mean buying 500 shares of a company that has a brand new technology that will lead to a huge payoff if it works out, but will tank big time if it doesn't. Fortunately, those 500 shares won't have a significant and adverse impact on your life or financial future. The speculator. Speculating is like financial gambling, and that may sound harsh, but I think it's fair enough. The speculator wants big gains and fast, not in years, but in weeks or months. The speculator would have a heavy dose of options, see Part 3, and small cap stocks, but hopefully, like the aggressive investor, keeps the bulk of his or her money in conservative investments and limits the speculative trading to risk capital. Starting point: a model portfolio. One of the great investors of the late 20th century was Harry Brown. His strong analytical abilities, coupled with his investment experience, Brownie. So he was Brown. His last name was Brown because he was brown. His strong analytical abilities, coupled with his investment experience and expertise, easily land him in chapter 17, where I discuss legendary investors. But I think he also deserves a spot here. In his book, Fail-Safe Investing, he makes the case that long-term investors shouldn't try to outsmart the markets or heed the forecasting. Clarion call of the investment guru of the day. Instead, Harry argues for a simple portfolio setup and notes how, in most cases, it beat out any market experts or vaunted forecasting system. Harry recommends that the investor allocate 25% equal in stocks, bonds, cash, and precious metals. In a given year, one or more of these components will do well, and the others will underperform. At the end of each year, the investor reallocates to keep the portfolio at 25% for each segment of the portfolio. The value of the strategy is that it takes the guesswork out of allocation, and you can take advantage of how markets ebb and flow. For example, suppose you take $4,000 and allocate $1,000 in stocks, $1,000 in bonds, $1,000 in cash, and $1,000 in precious metals. Say that stocks perform very well, so that components of the portfolio at year's end is worth $2,000, whereas other components are still $1,000 each in value. That means that the portfolio is at a market value of $5,000, or a 25% increase, which is very difficult to do, I think, but it's possible. Stocks now being 40% of the portfolio, 2,000 of the 5,000, while the other three components are 20% of the total. Given that you sell a portion of the stocks, take the proceeds and distribute them across the other three components to rebalance the allocation so that again you have 25% in each component. Now each component is 1,250 as you head into a new year. Use Harry Brown's allocation model as a starting point and then tweak it to meet your particular needs and risk tolerance. Given today's trends and overall market conditions, see chapter 19. Here's a good starting point for the readers of this book. Put 25% in conservative dividend-paying stocks. Put 25% in growth stocks. Put 25% in bonds. Split the remaining 25% between cash and hard assets, such as gold, silver, and collectibles. Okay. Please keep in mind that this model can be modified as the investor sees fit. Younger investors, for example, should consider greater allocation to stocks and less toward bonds. Check with your financial advisor to find out what changes or modifications are appropriate for you. Thank you very much for your time. That was Chapter 3, Surveying Diversification and Allocation Strategies.